Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol & Associates Asset Management.
Okay, everyone. Good day and welcome to our weekly research meeting. Joe Pashadiniak's going to lead us off with lots of things and PL Capital. Good to hear an update from them. I'm going to hit my mute and my video buttons so there's more bandwidth for everything. Go for it, Joe.
Great. Thanks, Dave. Good morning. Just an update on the Financial Edge Fund as well as Atlas Sky Fund 1, and then a kind of a medium sought strategy charts of the week pack. PL Cap is a new firm to our platform, but they're hardly a new firm. The managing principals have been in the industry for decades, and their one fund has a track record that goes back to 1996. And I think the long-term strategy is really what these guys are all about. So here's their little distillation apparatus, so to speak. It is a concentrated portfolio of publicly traded banks, which is interesting because we could just go out and buy them ourselves. But I put the red arrow next to the meaningful non-passive ownership bullet point. I like the way that was represented. I've not heard that term before. Obviously, active, passive, we all know that. But meaningful non-passive ownership means that there's really a lot of conviction in the names. And just taking a look at the performance, it's been pretty good. I think the better barometer is really the Nasdaq Banking Index, which they're kind of trailing slightly in the first half of the year, which more or less is the time we've been with them. But the longer term is, as I say, pretty good. And 1900%. I mean, the S&P 500 is of course more than that. But in recent years, that S&P, the cap weighted version of it, has become pretty congested up top with AI and tech names, and so it's good to see some of these bank holdings. This is back to long term. I talked about their sort of track record going back to 96. This is sort of a longer term, wide angle view of the banking sector, and kind of takes me back from like grade 9 or 10 to kind of where we're at more or less now. So you can see like the savings and loan crisis, the recovery, LTCM recovery, global financial crisis recovery, so on and so forth. So they reckon that we're kind of in the early stages of a multi-year run in banking. Of course, that could be derailed by things like loan losses. But they think that the first sort of shot across the bow was made in this latest cycle with Silicon Valley Bank, and the other one that failed just a couple of years ago. And so this one's really interesting. This is a slide from their own deck. You could see that from the 90s until now, the number of $250 billion dollar asset size banks has gone from nothing to 13. The number of 10 billion to 250 billion asset banks has gone from 60 to 140. That midline of 1 to 10 billion, has increased, but only recently. That 890 is sort of the outlier. The rest is more or less flat. And so it's interesting how all these banks and thrifts are evolving in the States. And obviously, as a Canadian, I just can't get over the fact that even to this day, there's like 4,000 plus banks and financial institutions, in the United States. And I don't know, being a regulator on that would be a little bit crazy. So very good. That's the Financial Edge Fund. So Atlas Sky Fund 1. So what is it? Who's sponsoring it? All that kind of stuff. So just by way of backup, we're investors in Cash Today's secured debentures. They are performing very nicely, and the company as a whole is the most profitable alt holding we have as an individual company. And so I guess in connection with demand for higher rates, Heart and Crown Cap put together a fund called Atlas Sky Fund 1, which is the fund vehicle that holds, at this point, about $228 million worth of the cash today secured debentures across a range of vintages. And so when you look at these numbers, it's very consistent because the debentures themselves pay 15%. So the fund fact sheet is just a straight 15% divided by 12. And very, very impressed with these folks. And we're just taking a look at adding them potentially to our debt fund. On a cumulative basis, the strategy has actually outperformed stocks and bonds together, and even the North American High Yield Bond Index, which is really interesting because subprime lending is high yield. I mean, these borrowers are not A-level credit people. And so again, the underlying loan portfolio as of the end of this year, it's more than 229 million, but the underlying loans seem to be performing. And sort of the only question I ever ask when I meet with them is, like how many of these are performing, how many are non-performing, what is, the action plan in place for non-performing loans. And they're a lot different from, again, the go easies of the world where, the collection policy was, there really wasn't one. And so this is sort of, again, the difference, I think, between, a family-owned business and using public shareholder money. So that's sort of it for the privates. Andrew, was talking about the major indices kind of hovering around these all-time highs. And, I think really looking through a lot of the stuff on rates and geopolitical noise and sort of the spin-off in semiconductors, which is good in the sense that, again, stocks are kind of by and large looking through that. But, as he says, that lack of, I guess, emotion or whatever kind of cuts both ways. And it makes it less certain that, some of these things have been priced in. So it's, it's sort of an issue of maybe, the market is just sort of enjoying its summer and taking a laissez-faire approach to these risk factors. But, sideways churn, he says, can substitute for a correction in some times. I guess I could see that. Like, stocks can't always go up. So sideways could be, it's like, what's the expression? There's buy, sell, and hold. And on the sell side, like a hold is, wink, wink, nudge, nudge, a sell. So maybe that's where he's getting at there. But looking at the charts, yeah, it's really kind of hanging in here between the, the 50-day and just kind of right around that first upper standard deviation. So not crazy overbought, just kind of doing its sideways thing there since, that sell-off in June and maybe stabilizing for another run higher. And so, yeah, a little bit more here on this 7,500 point pivot zone. We've talked about it before. This one's really interesting because this is, of course, the VIX. And, if you just sort of look at the VIX, you'd be, forgiven for saying that, there's not a lot of implied volatility out there. But he says that individual stock volatility is very high. And I presume he means the semiconductors and sort of the more higher beta parts of the market. And so, for any of that to change more broadly, you really want to see a big spike in the VIX, which, just really hasn't happened since kind of April, May. So maybe that'll change, maybe not. Oil, I think it hit $90 this morning. So looks like it's heading to this key point here around, $90, which is sort of that point in which you have the convergence of these two trend lines and a nice bump off that lower support level in the high 60 range. So we'll have to see what oil's doing. And precious metals, so these things really sold off. And, this is where you kind of separate, I guess, the long-term investors from people day trading. A lot of people did not budge on their, metals positions. And it was unpleasant to kind of see that sell off, but looks like they're starting to perk back up. Very interestingly, only the forums that are dedicated to the mining space, like Kitco, for example, are really talking about this. And with gold and silver, Andrew himself is not 100% convinced that the low has been made, but you're definitely back into this buying zone. And I've been watching silver like a hawk for the last couple of days. I thought it was going to pop back up into the 60s and then maybe make a move to the 70s. That's sort of the buzzword around the water cooler, so to speak. It didn't quite happen this morning, but for now, looks like a pretty good entry point potentially. So that's it for me, David. I'll stop sharing and pass it back to the team.
Ken, take it away.
Just quickly go over this weekly report, July 23rd, 2026. Just quick disclaimer, not giving securities advice for Canadian investors. And same with American investors. This is our Securities and Exchange Commission disclaimer that our lawyers give us. Just quickly going over the indices this week. This isn't over a 2-week period as I was off last Thursday. This is the S&P 500. Looking here, there was actually no change over the last 2 weeks on this chart. Relatively flat 2 weeks as investors are seemingly pricing in risks and potential rate hikes. Obviously, you had some strikes this morning, which is going to pull this back. So we have some heightened volatility and some uncertainty, and kind of has led to this flat period, which I'd say is probably not the worst thing possible after a very volatile, I'd say, 3 or 4 months prior. It does have a strong support zone to watch there at 7,300 to 7,250, so watch that. Current momentum, negative on the weekly. It's the longest negative momentum weekly streak since January to March, so really flipped over in the last few weeks. Overbought, oversold 7%. That's the second lowest in the last 5 weeks. And the AI names are continuing to be the market laggards, X semiconductors or select semiconductors. And then some of the hyperscalers like Google and then even Tesla are leading the market on the downside. So we're seeing a lot of uncertainty, a lot of de-risking of investors' portfolios, and the strongest sector of the last week, energy, with the price of oil obviously rebounding. Yesterday, I did this presentation at the end of the day after the close. Oil was trading at about $84 a barrel. This morning, up to $91.50. So really going to benefit that energy complex, obviously. Looking here at the NASDAQ, no box change over the last 2 weeks, new sell signal. That's the second straight. That's the first time since 4 straight at the start of this year. It does only have one short-term support line, which you can note there at 28,400. So we'll be watching that line very closely in the coming days and even today. And the overbought oversold was oversold actually for the NASDAQ at about 12%. That's the second lowest since April 3rd. Last week was about 31% oversold. So pretty strong selling pressure. Investors, as I said, de-risking their portfolios. One of those drivers, obviously, the elevated PE ratio. And then the Dow Jones, no box change over the last 2 weeks, like the S&P, remains at an all-time high. Support is 6, 9, and 11 boxes lower, so a nice zone there. Obviously, the strongest last week in the Dow and the components were healthcare and energy, while some tech and financials lagged. I would say it does have the strongest setup amongst the U.S. indices. This week, or last week, excuse me, it broke the longest positive momentum weekly streak since 2006. So a change over there. And then the overbought oversold was actually about 30%. So the demand remains there for the Dow Jones relative to the S&P and even the NASDAQ, despite the market uncertainty, which could be a potential in my opinion, foreshadowing of a value rotation, a defensive rotation. As I said, investors de-risking their portfolios. Looking here at the TSX, actually only increased one box over the last 2 weeks, despite the commodity volatility, still up about 11% year to date. Oil rebounding has led Canadian energy producers higher after their kind of pullback, with oil pulling back from the hundreds all the way to the high 60s, and now back to the low 90s we mentioned in the past weeks in the weekly beacon, and even in my portion of this presentation, and even Joe, I remember talking a few times. The floor price seems to be much higher than it was pre-conflict in Iran. So we weren't taking all of our money off the table in the energy sector, and we're glad we're still in that trade. Overbought, oversold 50%, highest in 3 weeks, still remains elevated despite volatility. And it's been above 30% every week since May 22nd. So you can see there's still demand for Canadian equities. And that major driver of that is obviously more attractive valuations, investors looking for other markets other than the US. And the energy trade, obviously a bulk of our capital markets are energy. And when energy prices are elevated, Canadian markets usually are benefiting. This is the VIX. Not a lot of changes on this chart over the last 2 weeks. It had a new sell signal last week, followed by a buy signal. It's been in the consolidation area, in my opinion, over the last 8 weeks, where it's been trading between 22.5%, 23%, all the way down to about 15.5%. So we haven't seen a break up or down. We're in this downtrend for quite a long time. We haven't really broken it, in my opinion. We're just running flat. So we'll have to see if we break to the upside or downside. Bullish percentage charts, these two haven't changed in the last few weeks, so I'll just jump past these. Same with the percentage of companies that are trading in a positive trend for the NASDAQ and the Dow. No changes there. And then the Toronto Stock Exchange technical indicators, neither of these have changed as well, which I'm surprised, just because of the strength that we've seen in the Canadian equity markets. But I'll just jump over that. Couple more slides at the end that I want to key in on. Looking here at the asset class rankings, very quick turnover for the Asian Pacific developed market asset group. Think obviously South Korea, Japan obviously struggling, currency at a multi-decade low. South Korea seen a real big pullback in their equity markets, despite the South Korean equity markets up like 100 and 110% still over the last year, and up, I think, 20 to 30% this year. It's seen a big pullback with the semiconductor companies pulling back, investors de-risking their portfolio, tech obviously getting hit on the chin in recent weeks. You can see the loss of buy signals here. It was at 240, so a loss of about 50 to 60 buy signals just over a few weeks. We had mentioned in industrials, healthcare, financials, and utilities, more defensive industries. Obviously, certain select industrials a little more defensive than the cyclical ones, but really showing up in this sector rankings that we look at every week, obviously. And then you can see down in commodities, agriculture. We think agriculture is going to continue to heat up. Input prices continue to heat up. Potash continue to heat up, which will benefit a lot of the agriculture producers that are beneficiaries of higher agricultural prices. But you can see here, these are actually just the spot commodity prices. Most strength within the commodities. They're obviously precious metals, really out of favor this year. Energy picked up several buy signals this week, and I would assume with the price of oil spiking to 91 this morning, that will be much higher next week when we look at this. Just quickly flipping to the sector spotlight, I had mentioned South Korea. We'll talk about that a little later, but this is the emerging markets ETF relative strength on the left side, EEM versus the S&P 500 equal weight. And then you can see on the right side, it's EEM versus the MSCI ACWI ETF. These both reversed last week in terms of relative strength. So it basically means EEM is out of favor. They've both been in favor for over 12 months, and they flipped over this week. We're still believers in the emerging markets market. Perhaps it's time to look at a different area to get some exposure. You can see here the pullback from 71 all the way to 63, just in a few weeks, obviously. Big driver of that, a lot of the companies within the Vietnams of the world, but companies that just are producing semiconductors, Taiwan, those two markets have seen large drawdowns, which is driving this EEM pullback. Same with China, and same with South Korea, that makes up a part of this ETF actually. And you can see on the bottom there the ranking of major asset classes and where EEM has pulled back over actually a 20-day period from June 30th to July 20th. The drawdown of about 7%. So not a huge drawdown, but still something that we wanted to note, just with where we're seeing fund flows and stuff. Here's the tech volatility relative to the market. This is IYW, which is the iShares US Technology ETF, and it's tracking basically the IYW's 90-day standard deviation and the S&P 500's 90-day standard deviation. You can see right now we're at a 2.0, above a 2.0 actually for the first time since a brief period in 2024 and then a brief period in 2018. But you can see the last time that there was a sustained period of the tech industry having over double the standard deviation or trailing 90-day standard deviation of the S&P 500 was back in the dot-com era, which is not a surprise. So we'll have to see if this continues, just with the large swings we're seeing in the hyperscalers, the semiconductor companies, et cetera, or even the software companies earlier this year, just continues to persist within the tech industry. And you can see here two big drivers of that volatility in the tech industry. Semiconductor ETF on the left by Van Eck. You can see semiconductor companies are down 15% from all-time highs. Numerous of those companies are down even more. You can see the three sell signals, pretty dramatic pullback we've seen in just a matter of 3.5 weeks. And then you can see on the right side, that's the memory ETF. Memory chip manufacturers are down even more, over 30%. And that's only since late June. So that's a 4 and 5 week period where we've seen a pullback from about $81 in this ETF to, I think, as of 2 days ago, the close was 55, but a few days prior was at 49. So really large pullback in two, obviously, companies that are benefiting from, or not companies, ETFs that own companies that are beneficiaries of AI. But you can see here, this is just Dorsey Wright talking about why it's important not to overreact. Talks about the overall U.S. tech industry and the recent bull market that we've had, and the overall sector not being a stranger to large corrections. You can see here, these are large corrections in the tech industry dating back to January of 2023. You can see there's been a number, and you can see the news lines for various points. I'll send this around, but very interesting when you look at it, when you zoom out, that we've seen these drawdowns in the tech ETF compared to the one we're at right now. Obviously, some investors are probably overreacting, but we're not large holders of public tech equities, but just important, obviously, not to overreact. And then I mentioned developed market Asia continues to slide in the equity market relative strength rankings. This is the yen, which slid to a 4-decade low. Mentioned that a little earlier. Obviously, a lot happening in Japan, which is trickling into the rest of the world and potentially the rest of global equity markets. Obviously, years of low and negative interest rates is changing, and we're seeing massive outflows out of, obviously, Japan right now. So to see what happens next. And then this is just from the Bank of America Global Fund Manager Survey. Wanted to highlight this. This is gold. This is how managers are positioning themselves and where they think it's overvalued versus undervalued. And for the first time, really in over 2.5 years, managers are saying that gold is undervalued, obviously above the line. they're saying it's overvalued, undervalued. So perhaps this is a period where there will be some accumulation from some fund managers who've often ignored the precious metal. And then just highlighting here, this is crude oil. This is at 84. Like I said yesterday when I highlighted this, we'd be about back to here at about 90 today. Have to break 96 to make that positive trend line. This is a interesting, I guess, AI created image that I found online, which I found funny. Just talking about oil basically destroying the AI trade recently, and the Korea chip index down about 19%, like I mentioned earlier in this presentation over the last month, and just the price of Brent obviously surging on new strikes and headlines. So we obviously are still in the energy trade. We still like a number of energy companies in Canada and the US, and we'll continue to hold them unless something severe changes. And then last image, just created this week. Like I said, I mentioned couple of weeks ago that I was going to try to start using AI to create some of these images to end the presentation. It's a little SpaceX one. I actually used Elon Musk's Grok to create this one. It's just him riding the rocket downward, obviously, with the price of SpaceX stock pulling back by over 20% in recent weeks. So that's it for me this week.
Yeah, wait until they start issuing more shares out, and or at least, allowing insiders to sell out. Elon's locked in for 180 days, but there's other groups that can get out quite a bit earlier, and see if these index funds can support it, or are we just going to see this thing plummet down? Hope not. We've got a very little bit of it, so we hope to get out of this with some profits. Okay, let me jump into weekly video. And just the morning coffee literally just came in now, and I'm just going to set it up so I can jump to it when I'm presenting.
Hello guys, my name is Anthony Garcia. I'm one of the analysts here at NASDAQ Dorsey Wright, and I'll be going through the morning brief for today, 7/26. For starters, if we look at the performance from the major asset classes over the past day, you can see that crude oil and gold led the way, up 2.95% and 1.85% respectively, whereas the Russell 2000 was at the bottom, down 0.92% for the past day. And when looking at crude oil, you saw that it has come off the bottom, completing that double top break at $77, and now moving close to that bearish resistance line that's shown there. Still, the group is down significantly from its all-time highs. Year to date, obviously, is strong, 51% performance. But, year to date, since its highs, it's moved down quite significantly, along with some very notable volatility. So keep that in mind as you kind of move forward. And then similar with gold, we saw it move down significantly below its highs earlier this year. Has shown some near-term improvements, not enough to really warrant any major allocation. Did complete that double top at 4,100, so it still sits below, notably from its bearish resistance line as shown there at 4,380. Now, when looking at the NASDAQ composite, you can see that it sits on two consecutive sell signals as shown here after completing that double top break at 25,400. Still up to date double digits at 10.54%. That could change after today's move, but nonetheless, still up double digits for the index as shown here. And then for the S&P 500, also completed a double bottom break in early June, actually. Hasn't given us signals since then. Up 9% year to date, near that double digit year to date performance range as shown there. But when looking at the asset class group score page, you can see that the group has held up quite well, right? I mean, the S&P 500 is a pretty, it's a large cap index. It's still pretty diversified as it does hold 500 holdings. But looking at its ranking, you can see that it ranks third out of, roughly 134 groups as shown here. And it's kind of maintained this leadership on the asset class group score page really for the past few months as one of the top groups on this page. So something notable for the actual group. And then looking at the dolly, you can see that the technology sector, I believe last week, moved to second place with 183 signals. Looking at its signal count from the beginning of July, it's moved down quite a bit. You can see that it moved down roughly, 60 spots since 60. It's given 60 sell signals since the beginning of the month. So it has had a quite drastic pull down. But with the technology sector, that's kind of something that you would expect, right? Something that occurs actually quite often. And looking at our Monday's featured piece as shown here, this kind of details the volatility in the technology sector over the past few months and historically. You can see, looking at this chart as shown here, the third chart on the actual feature, it kind of shows you how often these different drawdowns occur at various different severities. As shown here, you can see a drawdown of 10% happens roughly once every 4.4 months. So, nothing really new for the actual sector. It's, obviously a growth sector. So you expect a lot of, minor and some major pullbacks whenever the group continues to perform well. But anyways, that's all for me for this week. I'll be back next week with any further updates. Thank you so much.
Okay, that was a quick one. Okay, Mike Coolbaugh has been away for a couple of weeks, but here he's looking at U.S. oil inventories. How long can depleting oil inventories mask the current reality? We're currently at the lowest levels in 45 years. Catastrophe waiting to happen? Yeah, I saw a thing on social media this morning. Once again, you never know if these are real or not, but it showed people in Russia actually fighting at the gas pumps because they've run out of gas for their cars. So that's a scary chart there. Japanese oil inventories. Okay, here goes a trend. The depletion in inventories isn't just a U.S. phenomenon. This is what Iran is banking on, and it's turning global. Okay, so that's Japan. I just mentioned Russia. U.S. 30-year real estate rate. Liquidity conditions aren't as robust as equity multiples suggest. Rising real rates are a major threat to this bull market. Yeah. Alphabet, it's off this morning. I think it's down 6% this morning. But this from the other day, Google trading just above its 200-day moving average in after hours as it raised CapEx guidance. Traders also realizing that their massive EPS beat was largely driven by investment gains, SpaceX and Anthropic. The CFO, debt expanded from $16 billion to $100 billion in 12 months. This is on top of the $80 billion in equity issuance. So dilution and way more debt. That's how they're going to stay in front of this. Now, the good news for Alphabet is they're sitting on all sorts of capital, but will that matter if we're into a declining market? Here's free cash flow for Alphabet. This is what we'll need to keep monitoring. As the largest spenders burn cash, they'll turn to debt and equity markets. But how long will investors tolerate the spend? Hidden AI debt, $1.65 trillion in AI debt. Leverage embedded in this AI race is far worse than it appears. Yeah. Bank leverage, big six bank leverage exposure growth. Bank leverage exposure has exploded over the past few quarters as they extend more balance sheet to hedge funds. This is just one depiction of what Sculptor is pointing to when it warns of funding markets. I'm not sure who he means by Sculptor. Speaking of leverage, plain stocks are so pre-COVID. As bank leverage exposure explodes, everyone is hooked on leverage products because of the new norm, while rates turn increasingly restrictive. Yeah, this is going to be putting in a top at some point. Retail frenzy. It's an eerily similar picture by retail investors in South Korea. The AI memory hype with SK, Hynix, and Samsung. Net dollar purchases are 78 times higher than they were heading into 2020. Complacency around the momentum unwind. As the narrative goes, a crowded factor unwinding, not an AI trade breaking down. Who wins the AI model wars? As we've shared, our view is that models will eventually all converge to something good enough. Our AI enablers theme is predicated on the software needed to run models processes. We don't care whose model wins or the cost efficacy of its compute. Gold, moving to gold now. I don't love gold here, given my liquidity concerns. However, we do have a positive momentum divergence at the key support level. We'll need to see more to get us interested, but this is a good start. Yeah. And that's it for Mr. Coolbaugh. While I'm on this same one, I'll just go over the prices of the market right now. As of last night's close, we got Canada, double-digit returns. The venture exchange continues to disappoint, worst in the world. Then you have Hong Kong negative and India negative. But look at Japan still. It's come off a bit from its peak of last week. But still incredible numbers there while their currency gets killed and inflation runs rampant. This is an inflation number here, really. And yeah, not much more to comment on those. We've talked a fair bit about oil already, but there it is, up 69% year to date and all green. So yeah, good thing we did keep our positions on there. And I think at some point we're going to have to add to them. Nat gas, though, is all over the place. I'll comment on gold and silver and copper with the point and figure data. Actually, I will on all of these, but just as a snapshot, you can see that our Canada US dollar has got a little bit weaker. So that's good for our US investments over the last year. And Bitcoin, well, it's up to 66,000. It's really not going anywhere, down 25% for the year. And then interest rates I will cover with this here. Okay, moving into our playbook. So nothing's changed with the Canada US dollar. Still has a short-term target of 70, so right where it is now, and a long-term target of 62 cents. So this appears to say that it's going to be going down in the future. Whereas the US spot index, ICE, is at 101 and measures up to 109. So that's, according to this, getting stronger, but all the pundits are saying it's going to be getting weaker. So that's what's make a market. Okay, now crude. So yeah, this is at 87 now, measuring up higher to 123, up 51% year to date. Nat gas looks to be going nowhere and down 20% year to date. The producers, though, up 32% and have much higher targets. So we'll keep our positions on. Copper, slight improvement there, up 15% year to date. With the amount of copper needed for everything going on with the plans of AI and energy, etc., this should be ratcheting quite a bit higher. Uranium flat, gold on the futures measures up to 4,500, but on the spot measures flat. So we'll have to see what happens there. As Mike Coolbaugh pointed out, it is at a bit of a turning point right now. The gold index bugs measure higher, the majors much higher, the juniors much higher. Silver from 60 to 70, and the miners quite a bit higher, and the juniors higher too. So that's all changed. That whole complex has changed in the last little while. And finally, crypto, Bitcoin at 66,000, still measuring down to 22,000. Yeah, that's a real failed trade. We've got very little exposure to it, so we're going to keep it that way until things change, or maybe they never will, but we'll see. Ethereum, though, is measuring quite a bit higher, from 1,900 up to 2,700. Solana way down, and then the crypto universe higher. So we're getting mixed messages there. Finally, with interest rates, Okay, the 2-year at 4.3 up to 6. The 5-year 4.4 up to 5.25. The 10-year at 4.7 up to almost 5, and finally the 30-year at 5.2 up to 6.2. So, yeah, there's still tons of inflation in the system. I'd like to see these numbers roll over and maybe start to have a flatter interest rate structure. That would certainly make the launch of our debt fund more desirable, but it doesn't really matter. We're going to be doing such things in such short durations that our debt in the various funds will be rolling over constantly. So it will take advantage of the inflationary environment while we can skim off some yield and coupon along the way. I'm going to stop talking there and pass it over to someone else. Chris, do you have any updates?
Hi, Dave. Well, considering the fixed income market, it's pretty turbulent. Obviously the rise in oil prices has really affected interest rate expectations, and I did want to point out that for the first time in a long time, we're seeing a potential interest rate hike in Canada in December. So we're at this is off Refinitiv, and the implied rate is 22.5. So not quite the full quarter point, but getting closer. And that's a big change. We haven't seen that in a long time. U.S. interest rate hike, futures forecast has moved up to be, looking like a slam dunk for September, 25 basis points, and then another hike at the January meeting. So, and that's reflective in the 2-year U.S. So the 2-year yield now is 4.36, which the range on the Fed funds is 3.5 to 3.75. So a midpoint of 3 5/8. So we can easily, the market's easily anticipating 50 basis point increase in the Fed funds and perhaps a bit more, and that's all oil related. And looking for some commentary on what's going to happen in Iran, and that's not my my don't want to get into forecasting that, so I'll pass it back to you, Dave.
Okay, thanks, Chris. Yeah, there's some Simon Hunt commentary that you should take a look for out there and see his comments on Iran. Over to you, Gilbert.
Thanks, Dave. This is going to be a quick one, short report today. Just one real thing I want to point out here, which I've been pointing out for some time. The market's essentially this is the S&P 500 weekly chart here. You can see on the top right, we've been consolidating, I think, since the beginning of May. And I guess that old adage, sell in May and go away, might have been right. Not necessarily because the market's going down, but because we haven't seen much upside since this point here. I want to highlight this because this was a consolidation period after a very strong rally that we had off of the late March, early April lows, similar to the rally that we had off of the April lows in 2025, although that was a little bit more protracted and extended. And previous to that as well, you can see these consolidation patterns where the market goes sideways typically are followed by moves lower. And if there are supporting contexts that would allow to support that, then that's all the more reason to believe that. And that's what I kind of want to present right here. Credit spreads. This is option adjusted spreads here. And as you can see on the bottom right, we're now in a very, very tight period, a very tight spread here. And the only thing that I want to point out is typically when we've had tight spreads like this in the past, that it's not necessarily that the market sells off right away, but there's very limited upside from the market here. So this is a sort of a barometer that correlates to market behavior as well. And so I would just be cautious here with regards to the potential for more material upside. Cape ratio here again, not much has changed. Just wanted to point out that we're again at these .com levels here. So yeah, there will be some
I think maybe some last fleeting rallies or whatever the case might be, similar to what we saw in 2000. But there was a lot of volatility at the top then as well, and so we might see ourselves having a market like that. Defense versus growth. The only caveat that I would point out here is, yes, we are at similar levels to defense versus growth as we were in 2000, but calling for a crash might be a little premature. And the reason why is because we can see in 2000, down here, in 1999, we went from a ratio of 120 to 360, basically tripling in 1 year's time. Now, the current rally took 1 decade. So we started off at that same ratio in 2016, and now it's 2026. And it's taken its time to get up to this ratio where growth was outperforming defense. And so, yes, it might be the case that we'll see a pullback from here, that there is less upside for growth relative to defense here. However, I mean, when we look at the staggering rate at which that rotation happened in 2000, we compare it to where we are today, it's not that same, everybody's on one side of the boat and then everybody rushes to the other side of the boat sort of scenario, right? And so we've seen this in other markets as well. But just to point out that, growth might not be as attractive as we get to these relative levels compared to 2000, but it's really not. I wouldn't be forecasting the same sort of crash that we had in 2000. Market breadth, again, I pointed this out. This sort of red band typically is where we get resistance. Now, 2024 is a little different. But since then, in 2025 and this year, that level of 70% of stocks trading above their 200-day moving average, that's essentially been the line in the sand. And you can see here in September of 2025, it was the line in the sand in February of 2026. And then more recently, again, 70% is the level. So we can't seem to get full participation and full breadth in this regard, but it seems to be that the market doesn't want to get up here. So the current situation really right now is that we do have an extended S&P 500 above the 200-week exponential moving average. We're in a consolidation pattern that we've seen previous to previous declines. Credit spreads are narrow. CAPE ratios at dot-com levels. Growth versus defense is at the dot-com peak, and market breadth is approaching its limits. And so when I look at this in concert, it makes me a little cautious, right? And so if you are cautious as well with regards to downside and you want some downside protection, if you're watching this on YouTube, if you're new to McNichol & Associates, again, it's important to prepare for the inevitable. We have a solution with our partners at Universa. You can stay invested while being protected on the downside. So give us a call and we'll take a look at that. So that's it for me. I think I've stopped sharing here. Yeah, that's it for me. Anybody else want to comment on that?
No, good report. Short and sweet today. We've got a busy day.
Yep.
So unless there's anything else, I'm going to sign off.
Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit mcnicholasset.com to learn more.